Ferrari is set to report first quarter results tomorrow morning, and to prepare, we're going to take a look at where consensus estimates stand relative to management's guidance. And for this analysis, we're going to be using our Ferrari earnings model. You can download this model on our website, gutenbergresearch.com. Just click on the Models tab and then scroll down to Ferrari and click the icon to download. And for the guidance, we'll be using the details that management gave us on the fiscal fourth quarter earnings call. And that's available on the Ferrari Investor Relations homepage. So there's one actual difference this time around. Last quarter, for the Ferrari management, they actually produced the FCA group results a few days ahead of the Ferrari results. So we got a preview of revenue and some operating margin details for Ferrari. We didn't get that this time because the group results are actually slated to be released on the same day as the Ferrari results. So that's probably a good thing because a lot of people were caught off guard last quarter, and it seems like from now on we'll probably be getting the FCA results on the same day as the Ferrari results, so we probably won't have to worry about that going forward. So before we get started, we should just take a quick look at our Ferrari model because it is a little bit different than some of the other companies that we cover. The basic setup is very similar to the other companies. So if you see these dark gray headings, those represent historic actual details, and then this light gray represent the future forecasted periods. Anywhere you see blue cells, those represent our primary estimates. Purple cells represent company guidance, and orange cells represent consensus estimates. We start with the income statement, and then we have some segment details, some basic ratio analysis, and a breakdown of adjusted EBITDA, change in the adjusted shares, which for Ferrari there haven't been any changes yet, and then a breakdown of the net cash per share. Since it's a tier 2 valuation model, we only use one valuation approach, which is the market multiple based approach. So from that standpoint, it's a relatively simplistic model. However, since the group results are reported in euro, we have to translate the results back to USD for valuation purposes, since this is a US listed company. So that's how it's basically set up. And then if we get into what drives our net revenue, you can see that we break out the earnings the same way the company does. So we have this section here, which represents the focus of our earnings, and that is the revenue for cars and spare parts. So we have some shipment details and then an average selling price per car. We multiply the two together, and that gets us to our total cars and spare part estimate. And then we have three additional segments down below. So we have revenue from engines, sponsorship, and then other revenue. So those are the main drivers of our total revenue estimate up here in our income statement. So that's actually where we'll start, because we did get some details from management last quarter on some of these categories. We didn't get much of anything for sponsorship and other revenue. So in our model, for those two categories, so that's this one here and this one here, we kept the growth rates in revenue constant from the quarters of last year. So if you look here, the first quarter growth rate was about 1%. We kept it almost exactly the same. For other revenue, it was a decline of 32%, and we kept it pretty much the same. Now for the engines, management did give some details on the earnings call last quarter. They said that the engine revenue would stabilize in the back half of the year. So you can see we kept the first quarter growth rate, or actually a decline of 25% from the fourth quarter of last year. And that's just kind of consistent with what we were seeing in the past. But we did have that revenue stabilize in the back half of the year. So you can see we're up 25% quarter over quarter in the third and fourth quarter. Then we get to the main driver of earnings, which is the total shipments and average selling price per car. So management doesn't actually give details on what their expected ASP is. And this isn't really a true ASP because this includes spare parts. So this is really more like saying, what is the total average revenue per shipment during the quarter? So including parts. So what we did is we kind of backed into this number. So if you look, they did give us details and total shipments for the entire year. So they expect to ship 7,900 vehicles in the full year 2016. And we broke that out throughout the year based on similar trends that we've seen in the past. and then we know that we needed to get back to the consensus revenue, top line revenue estimates in euro. So we use the average selling price to get there. And then after that, we kind of do some analysis and take a look at this and see if this average selling price makes sense. So if you look back to last year, in June, they were at about $281 per vehicle. In September, they went to 275, and then they came down in December to 264. And we know that they're going to have some LaFerrari sales in 2015. So we think maybe the majority of those will come in the first quarter, which means the average selling price will be a little bit higher in the first quarter and then a little bit lower in June, and it'll sort of stabilize at that point. And of course, the different currencies and where they sell these vehicles will have a significant impact on the total average selling price, but it's a little bit too difficult to predict out for the rest of the year what the currencies are going to do. Now let's scroll up to the top of the income statement, and we can basically add up the 4 quarters of the year. We get back to a total revenue of 2.948 billion. And if we look at what management's guidance was, they guided to 2.9 billion even. So we would say that going into this release, the consensus revenue estimate is in fact in line with management's guidance. So about 48 million ahead of the actual number that they gave, but that's, not significant. And then we can move down the income statement from there. Management doesn't guide every line. They did give total EBITDA guidance, and we'll get down to that. And they didn't guide each individual item, but they did say that the R&D would stabilize in the back half of the year. So if you look down here at how we actually predict R&D and the other OPEX items, we do it as a percentage of revenue. So for R&D, you can see we're at 19%, and then we're saying 17% of total revenue for the September and December quarter would be our definition of stabilizing R&D. So hopefully we meet that guidance from management. And then using those estimates, we were actually able to get back to the total diluted EPS for Euro and USD for each one of the quarters. But if you scroll down to the EBITDA details, using an assumption for an average of depreciation and amortization, which is consistent with the third and fourth quarter of last year, we actually come back to a slightly higher adjusted EBITDA than what management guided. So their guidance was for 770 million euro, and our estimate that we required to get back to that consensus EPS estimate was 811 million euro. So that might mean that the consensus EPS estimate is slightly ahead of the EPS estimate that's implied by management's EBITDA guidance. Now that we have our model calibrated to meet consensus estimates, we can scroll down and take a quick look at the valuation heading into tomorrow's release. So we value shares using a next 12-month price-earnings based ratio, and shares are now trading at about 28 times the next 12-month consensus EPS estimate, and that's on an ex-cash basis. So you can see that we take out the value of net debt per share before we actually do the valuation. And that represents the 3-month high, so we're definitely at the high end of the range heading into this release, but that just might be an indication that the street is looking for better margin details than what's actually in our model. So if you'd like to download this model and try and plug in some different gross margin or operating margin assumptions and see what the impact is on earnings, it's available now on our website. And be sure to join us after the release when we update this model for the new details and any new guidance provided by management. Thanks for watching. Good luck with the release, and good luck with the rest of earnings season.